Why does it always feel like this? After we buy, the price drops. Or worse, market crash, minus 36%. Or how about this? After holding on for so many years, the gains are just so small. Might as well just buy fixed deposit. So today in this tutorial, I'll be sharing with you the whole emotional roller coaster, ups and downs, gains and losses, gains being wiped out. I'll be sharing with you using 5 key phases to approach your investing a bit better. And if you stay to the end of this video, I'll be sharing with you an actual P&L that still has more than 80,000 gain. If you're interested to find out, continue watching on. Hi guys, welcome back. Today I've prepared a whole presentation to show you the roller coaster when you invest in the financial markets. So let's, without further ado, get onto things. This is a chart that I've prepared for you. And over here, I really want to explain the whole investment psychology in 5 phases and why you really need to invest for the long term. Let's start with this S point over here. You realize this is typically where new investors get started onto the financial markets because they've seen for the last few years a big gain. And let's put that number at 45% gain. So previously, markets were 45% lower. Right now, at point S, where someone starts, there is a lot of comfort through recency bias, seeing that markets have done well. It looks safe. But lo and behold, after someone gets started in terms of investment journey, minus 10%. Not expected. Probably, along the journey, everything that they were trying to focus on was the green. FOMO, other people's story in terms of investments. And typically, that's where at point S, there's a lot of investment advertisements. This is a secret formula to invest, or my special method in terms of investments, join my course, etc., etc. And what we can see in the journey is, finally, after hearing some good advice, the investor is willing to hold on and finally saw a gain of 5%. 5% only, having to survive a minus 10% straight after buying. But the worst is yet to come. Some bad news hits the market. As of now, there's war. In future, there could be trade tensions, inflation risk, nobody knows what's going to come, or even COVID. So these are market shocks that will happen in future. And if you follow this whole tutorial, you realize that the patterns always look the same. And after this whole big news, minus 25% hits the market. The 5% gain is wiped out, and now the portfolio after 1 year looks minus 20%. Horrific, correct? But in today's example, we use an assumption. Every time market goes up, it goes up by 50%. And when it comes down by 25%. And this is the first phase, and I'll call it the test of faith phase. Testing your faith, whether after 1 year you throw in the towel or not. Maybe investment is not for me, or I want to try another method of building wealth. This is typically a test of faith. So hopefully, through this whole tutorial, you survive the test of faith phase and you get on to the next phase, which is temptation to cash out phase. I don't know how long you've been investing, or maybe you are also a long-term investor. You can also share some of your journey. What we can see in this second phase is that finally, after all the trauma that's impacted the market, markets lost 25%, correct? Markets have rallied. But then comes the new phase, which is this over here in 2 years' time. After finally seeing some good gains, markets have yet another bad news. Finally, sunshine, but then that sunshine is short-lived. Very hard to get around. I do get it. And at this point in 2 years, all the gains are wiped out. Back to zero. And why I call it the temptation to cash out phase is because new investors tend to throw in the towel, protect whatever profits they have, and try to eke out from the market, get away from the market, from the pain, because they have seen the trauma of minus 20%, correct? They don't want that anymore. They want to exit the market, and even if it's at zero or just peanuts in terms of gains, they are more than willing. So this is called the temptation to cash out phase. And if you are hearing my tone, I'm suggesting, if you're at this phase, learn from this tutorial that good things are after this whole phase. This is a test for you. If you pass it, you'll get rewarded. If you don't pass it, you realize that you're always changing new investment methods, finding the holy grail, and yet it never comes. Now is growth investing. 10 years ago is value investing. Then you're always looking for a new thing. It could be crypto. But the problem is the same. If you see the patterns, it kind of is a reflection of your whole fear, as well as your whole experience sensing, and as well as your whole biases. So if this sounds familiar, help me smash the like button. It's taken our team hours to prepare this. And I have good news for you. Because if you survive the temptation to cash out phase, next up is the overconfidence phase. Sorry, not the best news yet. Slightly better news, but there are problems. This is what you need to watch out for. If you have been investing, you survive the temptation to cash out. And as we said, we will see a new gain to a new high. Finally, at point C, you realize that markets are 30% favoring your portfolio. You see a 30% gain in 3 years. Wow. That is close to 10% gain if you analyze it. Finally, it feels that markets do indeed reward investors. If you survive to this phase, you kind of have a bit more thick skin to survive crisis already. You'll be a bit more wiser. But this is also a phase you cannot let your guard down. This is called the overconfidence phase, because at this point, you'll be tempted to add in more. This point C is actually a reflection of point S if you come think about it. Hey, markets come out, you invest more. And that's why on this channel I've always suggested that very often bad results happen because at the top of markets, most investors pour in everything they have, instead of going slowly or going for a plan or buying at the bottom. At this phase is where people are more relaxed. They have, again, recency bias at stake. And if you look, this looks very much like S. We can call it even S2, a similar start of a cycle that could pull investors to the wrong direction. Hopefully, you are aware that this could happen and don't pour in at point C, because that is not the time to get greedy. Because if you do, you will not survive the next phase, which is weather a storm with your profits phase. This only happens if you do not pour everything that you have into the market. The main part about this is if you are pouring everything at point C, you might even see your portfolio after 3 years losing everything. This whole 30% gain is wiped out. You go back to negative because you start the whole cycle again. And you'll be thinking, why? Why did I not make money? And why did I not cash out at point C? I finally gotten good returns. And that's the main result of not being able to overcome the fear of missing out. So point D, if you were consistent, you realize that you are now at this weather a storm with your profits phase. This is a phase to congratulate yourself. If you didn't pour in at point C, you realize that you can actually get to a weather a storm with your profits phase. Because our assumption is every downturn is minus 25%. You realize that even at the worst of the market, you are still positive. I shaded these in green. And if you are at this phase surviving, congrats. The journey ahead probably looks green forever. You would never see your total investment journey in a red ever again. Fairy tale ending. But that again is at least 3 years down the road. Many think investment long term is 1-2 years. Or, we live in such a fast-paced world these days, and 3 years seems like a long time, and we have to weather a lot of problems. You get it? So at this phase, if you can survive, good times ahead. Because over here, I can show you that markets will indeed reward you. Goes up 50%, that is A2. A2 is similar to A, you realize? And then it comes down. But then whenever it comes down 25%, you're never at that low point where you're at losses. It's just a giving back of profits and you ride up a new cycle. Giving back of profits, ride up a new cycle. That is why, people make money in the property markets. You realize? They don't flip properties. People who flip properties may or may not make money. But people who own a home for 10 years, 20 years, it's a no-brainer. There'll be some gains. The problem is how much gains only. So apply that whole same principle. You ride waves up 50%, down 25%. Continue the journey. Up 50%. And you see over here, I put this arbitrary numbers. But the principle is the same. If you are able to ride long terms, equity markets can reward you double digit. It is possible. It's really where you draw the end line as well as where you draw the start. So pulling back to today's discussion, I have a few key points that I want to hear from you. Where are you on your journey right now? Is this message catching right point of time because you see Nasdaq crashing, you see Chinese tech crashing? I'd like to hear a point of view also before sharing this key message for you, which is this. If your portfolio is in the red right now, at this juncture, it feels impossible to expect 5% per annum or 8% per annum from the equity markets. There's a key bias at work, which is recency bias. You're seeing your recent trauma, your recent experience in the stock market, and forgetting that on a historical basis, markets reward on a long term. Recency bias is at stake, is giving all this irrational fear to you. And if you know how to conquer the irrational fear, you'll see big results. That's a key message from today's video. Let me show you an example. And before I get there, again, smash on like button, because this is really going to be an eye-opener. This is a particular portfolio that I have in a customer's account. And what do you see? 82,000 gain from a total investment of 228k. Total profits 35.91%. And again, this remaining percentage and remaining profit is after the trauma that the market has thrown to this portfolio already. Take a guess, when was this portfolio started? And leave in the comment sections. I'll tell you whether it's earlier or before that. And with that, you kind of have a guess of this journey, and hopefully this has bring you a bit more optimism to look longer term to survive the crisis that you are facing right now. With that, I'll sign off from this video, and as always, check out some of the previous tutorials I have that could help you in your investment journey. I'll sign off from here. Take care and goodbye.